What's going on, YouTube? Today, if you clicked on the video, I want to show you how to go into the market and spot a particular strategy that can get you 30 plus pips a day. Then also want to show you how powerful that 30 pips a day can be when it comes to multiplying your money. So imagine you started off a $1,000 account, and at the end of a year, that $1,000 account is now worth $30,000. So if you're interested, stay tuned. Okay, so here I'm using an app called TradingView. TradingView is a charting software, really cool. If you're interested in how I set up my TradingView chart, click on the link above. I'm gonna post a video where I go through and explain how I go and change all my settings to make my candles look like this. So let's go ahead and get into the strategy. So first thing that you want to do is you want to look for a trending market. So what is a trending market? A trending market is this. You have a high, and then you have the market creating what's called lower lows and lower highs. So as you can see, the market started off right here at this point, at this high point, and it came down and touched this point, making a low or a floor. All right, so then it pulled back up and created another high, but that high is lower than this high, aka a lower high. As we can see, the market continued to move down. We got a lower low because this low is lower than this low. All right, and we got another high, and that high is lower than that high, so it's a lower high, and you guys see the trend, right? So this is how you know you're in a trending market. Well, take a look at this. We have this market that is clearly trending in a bearish momentum, right? But on the bottom here, we had this indicator that is trending up. As you can see, this peak down here at this low point. Now, when this low point happened, it's lower than that low, but look at the peak. That peak is up higher than this peak, or not peak, but this dip. All right, and same thing on the next one. This dip is lower than that one, but as you can see, it is trending upwards. So as you can see, this particular indicator is showing that the momentum is dying as far as the pressure being the selling pressure, right? So it's actually gaining strength because you see this dip is low and this one is higher than that one. So this is what they call divergence, right? So what is divergence? So divergence is a powerful reversal indicator, right? It's when you see the price is falling, as in our case, but the indicator in this instance is called a MACD, but it's nothing special with the MACD. It's just the regular settings. So once you add the MACD, which I'll show you how to do that, it's the regular settings. All right, but this is textbook divergence when you have your indicator, in our case the MACD, is trending upwards, but our price is trending downwards. What you want to do in that instance is I personally set a trend line for the price movement or the price action, and then I wait for price to break that trend line, and I get a cross on my indicator. As we can see right here, we had these red bottoms, and then all of a sudden we had it peak up to the top. It went green, which shows that the buyers are showing up and that the bullish momentum is starting to gain. Okay, and so as you can see in our example up here, when price broke this trend line, we also had a cross of the MACD where it went green. It went to a positive charge, right? And so as you can see, we had a large candle come up and break. Let me zoom in. We had a large candle come in and break out above our trend line. As you can see right here, let me go ahead and do a circle right there. We had price attempt to break that trend line, but then it got pushed back down. Right here, we had price try to break that trend line and it got pushed back down. Right here, we had price try to break that trend line and it got pushed back down. But right here, we got this nice green bullish candle that pushed through that trend line, and then we got a flip of our MACD. That lets me know that it's okay to go ahead and get into that particular trade. And as you can see, this is a 4-hour chart for CAD JPY, and if we would have entered right up in this area, either one of these two candles, so that's 8 hours where you had a chance to enter this candle. That's what I love about trading on the higher time frames. All right, the movements, I don't want to say it's slower, but you don't have to watch the charts as much, right? Because each candle takes 4 hours to form. So long story short, you could have got in at this first candle, but let's say you waited for a little bit more momentum before you got in. Right here, in this one small movement right here, you got 39 pips. All right, and that's powerful. So it's not about catching 400, 500 pips. It's all about catching, or the percentage of your account growth, which is very important in my opinion, as opposed to how many pips you catch, right? Because I can catch 1,000 pips and make less money than you. and you can catch 20 pips and make more money than me, depending on your lot size. So in this instance, then we got to pull back right where price came back down and created a new low. But look, that low is higher than this low, which lets me know that maybe this market is getting ready to trend upwards, right? Because now instead of creating lower lows, we're creating higher lows. So price was up here, came down, created a higher low that was higher than this, and then price came up and created a higher high, which is higher than this high, right? So now we're beginning to trend upwards. So if you didn't get out at this point, if you stayed in, because if I entered right here, my stop loss personally would have been down here. As you can see, it would have been 105 pip stop loss. Now that's one of the things when you're trading on the higher time frames, you're going to have a higher stop loss, which means that you're going to have to use a smaller lot size because you want to minimize your risk, because your reward is going to be greater, right? I risk 105 pips, but in my example, if I entered right here and I stayed in this trade, as you can see, it pulled back, but eventually it gained its bullish momentum again, and eventually could have came out with 130 pips, which is a 1 to 1.3 or 1.5, something of that nature, right? So I got a little bit more than what I risked. So in this example, that would have been a great trade. Now, look how long it took. It took a while, right? But that all depends on what kind of trader you use. But what's great about this strategy is that it works on any time frame. If you want to do it on a 30-minute, if you want to do it on an hour, if you want to do it on a day, week, whatever, it works. But just be mindful that if you're doing it on lower time frames, your outcome may be a little bit lower, where you may get 15 pips or 10 pips. So how do I get this indicator? Again, it's called the MACD. All you do is you come up here on TradingView and you click on this indicator plus strategies. Click on that and click on search and put in MACD. You click on it and it'll add it in. And yours may look a little bit different. I went and changed a couple of settings as far as the color, but I think I just changed the thickness if I remember correctly. So if I click on this, you'll see I just changed the thickness of the lines. The inputs stay the same. That's the basic inputs, 12, 26, and 9. But that's the indicator right there, guys. Let's go and look at how we talked about the power of the percentage of growth of your account versus how many pips you catch. So let's go and take a look at that. So here, we're going to go over to our compounding sheet. We're going to go over to the daily. And so let's say you start off with $1,000 account. Now, when you put in that 105 pip stop loss, you want to know how much risk that is. And we want the lot size. So the amount of risk that you take, we don't want it to be more than 2%. So in this particular example, you're going to risk 2% and you're going to look to gain 2%. So as you can see here, if you risk 2%, that means you're risking somewhere around $20, which is not much. But if we have 105 pip stop loss in our example, that means that our lot size will be a 0.02. Okay, and so that's how you would use this sheet. And so again, we're looking for a 1-to-1 risk to reward ratio at least. So you would put your take profit at 105 pips. So when your take profit hit for 105 pips, you would have made 2% on your account. And so if you can do that consistently every day for 60 trading days, you could compound your $1,000 account to $3,216. When it comes to trading, it's going to be a slow and steady process. You got to be consistent. You got to wait for the right setup and not rush it. When you try to rush the market and manipulate it to your wheel, quote unquote, that's when you get in trouble, and that's when you end up blowing accounts. If you try to grow too fast, maybe you're a person that wants to risk or don't even know what you're risking, right? You're just putting in a lot size because it looks good to you or whatever. But let's say you're risking 15%. Well, if you lose a trade, let's say you lose 1, 2, 3, 4, you lose 3 or 4 trades in a row, you can end up losing half your account that quick. And so with Forex, there is no guarantee, no 100% strategy, okay? But you want to place the odds in your favor by using a strong strategy, and then also always minimizing your risk. Now let's take that over to a weekly time frame. So again, we said 2% per day. I'm just going to use safe numbers, right? So if we can get 6% per week, that same $1,000, a weekly goal of 6%, and you do that for 52 weeks, which is an entire year. Bam, right here. That means that $1,000 account could be $19,525. So that's the power of compounded interest. One of the best ways to compound your money is in the foreign exchange market, and literally just gave you the keys to the game, y'all. Take it a step further. We had this withdrawal plan, taking that same $1,000 balance, growing it every week by 6%. Now, if you trade and you only take out 10% of your profit, so that means you make $100, you only take out 10. Okay. So it's not going to sound like a lot at first, but this is the power of compound interest, right? Again, week one, you're going to have $1,000 account. After the week is over, you're going to make $60. So technically you could withdraw $6, but I wouldn't do that. I would wait and just do it every month. So in this particular example, after 4 weeks, you're only going to take out $26, right? Which is not a lot, but it's something. Go and put $1,000 into a savings account and leave it there for 4 weeks and go back and see if you can take out $26 and still have $1,000 in that account. Won't happen. All right, but you have $170 worth of growth in your account and you're taking out $26. But let's just fast forward and go to 52 weeks, which is at the end of the year. So now that $1,000 account is up to $14,000 and you've withdrawn $3,000, right? So if we go all the way back up to the top of our sheet, this is the total that's withdrawn. So that means over the entirety of the year, you've withdrawn $3,000 out of that account. But now the account is up to $14,000. And you're doing a monthly withdrawal of $1,786 if you continue to do your 6% per week and only withdraw 10%. That means that this account is going to continue to grow. All right, guys, so that's the power of this particular strategy of how you can use divergence. And again, it works on any pair, any time frame. You just need to, again, have the divergence on the MACD. Do me a favor, if you liked the video, if you enjoyed the content, go ahead and give me a like. Also, if you have any questions, drop them in the comments below. I will be paying attention to the comments. And again, awesome strategy. If you've never heard of divergence, if you're not even sure what candlesticks are, shoot me a message on my email, and I got some help for you. And also subscribe to the channel. All right, lots of videos going to be coming out. I look to bring some value to you. So this is NIC PIPS, and I'm signing out. Peace.
Yeah, Bankroll, what up, man? Smaller. I had a dream, I had 1,000 pip trade with a standard lot size from the daily high. I took it down like a post I'm ashamed of. Ain't had a pay stub since 2005. We all in this together. Benzes, Suede with the Cartier lenses.